still filing. Well, good morning and a warm welcome to the Reserve Bank. Let me say that with me I've got John McDermott, who's the Chief Economist and the Assistant Governor, and Dean Ford, who's the Head of Forecasting. So they'll take some of the tough technical questions. There are multiple forces shaping the New Zealand economy, and the key ones are the changing global economic outlook, the scale of the Canterbury rebuild, the impact of the drought, the program of fiscal consolidation that the government has underway, the high exchange rate, and the buoyancy of the housing market, particularly in Auckland and Christchurch. Overall, the New Zealand economy is probably growing at around 2% or at a 2% annual rate at present, but activity is very uneven across the sectors. A key driver behind growth is the Canterbury rebuild activity, and we expect to see much more residential construction in Auckland. Despite having fallen in recent weeks, the New Zealand dollar remains overvalued and is creating headwinds for the tradable sector. We're seeing rapid house price inflation in Auckland and Christchurch, and we don't want to see financial or price stability compromised as a result. Our forecast suggests that the economy will be growing something like a 3 to 3.5% growth rate by the end of 2014, with the unemployment rate perhaps around 5% or a little lower, and the inflation rate being around the midpoint of our 1 to 3% target range. So given this outlook, we expect to keep the OCR unchanged through the end of the year. I'd be very happy to take any questions.
Mr. Wheeler, the forecasts assume that house price inflation will peak at 10%, even without any further prudential intervention from you. It's already, as you point out, stronger than that in Auckland and Christchurch. So what if these forecasts are optimistic? What's the plan then?
Well, as I said, I think there's real buoyancy in the Auckland market in particular. If you take the quarter up to the month of May over the same quarter last year, Auckland house prices are increasing at 15%, which is a very rapid rate. The challenge in Auckland that we have is really a very significant supply-demand imbalance. I mean, if you look at the council estimates, they basically say there's a shortfall of 20 to 30,000 houses. You need something like 13,000 houses built a year. In recent years, we've been building around 4,000 to 4,500 houses. And the Auckland Accord is ambitious in setting a target of 39,000 houses. But the challenge is really to try and bridge that supply-demand imbalance, and until it is bridged in a significant way, I think we'll continue to see house price pressures continuing to dominate. I mean, it's possible that our forecasts underestimate future potential house price rises there, but we're not anticipating that house prices will start falling anytime soon. We're still building in an increase in terms of the rate of house price inflation.
But given the time it will take for that supply-demand imbalance to correct. You can do something about the demand side. You're reluctant to raise interest rates until next year, but what about the other tools available to you?
Yeah, we're reluctant to raise interest rates because of the points I mentioned in the speech just 2 weeks ago. We are looking at macroprudential tools, having recently moved on the prudential side to raise the capital requirements for high LV lending. But the tool that we're looking at closely and that we're consulting with the market on LV ratios. And the issue is whether they can be applied in a way that in essence reduces the demand for high LV lending and also the desire of the banks to continue to offer loans to depositors with low deposits. So we're currently consulting at this point. And I think the consultations end, Grant, I think at the end of the month. Early July. And we're looking closely at how these tools have been used in other countries like Canada and Israel, Norway, Sweden and Korea.
Mr. Wheeler, can I just ask, is there being any consideration given to the impact on first home buyers when you're in those discussions with the banks?
You know, if you look at what many countries have done, they've carved out exemptions for first home buyers, but then put absolute constraints, limits on all other high LV lending. The thing that we're looking at, given that first home buyers are roughly 30% of the overall market for new mortgages, if you like, is the issue of whether we should introduce speed limits. So, for example, you've got roughly 30% of bank lending, mortgage lending, is to borrowers who have deposits less than 20%. So it's high LV lending above 80%. That's about 30% of total lending. That was about 23% 18 months ago. So banks have been competing very aggressively for high LV lending, and first home buyers are about 30% or 1/3 of the mortgage market in terms of mortgage demand. So that's why that would be a big, carving that out would be a big exemption, if you like, in terms of mortgage pressures. So that's why we're looking at speed limits, for example.
So just to clarify, you're saying you can't give them that exemption?
Well, as I say, we haven't made up our mind at this point because there are no final decisions at this stage, and we're out consulting with banks. But what I am saying is that first home buyers are a very significant part of the market, and the Auckland market is experiencing very rapid house price appreciation. So the issue that we're looking at is, should we set speed limits in respect of the amount of LV lending that we'd like to see the banks undertake?
Is it your job to give any consideration to fairness in terms of intergenerational fairness, and that might be tougher on younger New Zealanders trying to get onto the property market?
Well, we look very much at the financial stability issues and the price stability issues. That's what we're required to do under the Act. But there are issues of, if you see, for example, what you've seen in America and many other countries in Europe, you saw very rapid house price appreciation in the period leading up to 2007, when, and presumably in many of those cases, first home buyers were still struggling to compete to get into the market. Many of those that perhaps did get into the market then faced a situation where house prices declined very rapidly and they were faced with negative equity. Now, if you take the US market, for example, the amount of mortgage lending is roughly about 50,000 mortgages, if you like, just in general terms. Forgive me, 50 million mortgages. What am I saying? 50 million mortgages. And in about 2009, 2010, 25% of those, 23 to 25% of those had negative equity.
Matthew Brockett from Bloomberg News. Governor, you say that the New Zealand dollar remains overvalued despite its recent decline. Have you increased your intervention in the currency market since April, and is it your intention to continue to intervene where you see a necessity?
Well, we've said that that we're prepared to intervene if we think the circumstances are appropriate. We do have what we call a traffic light system within the bank that presents a number of criteria of whether intervention is appropriate or not. But what we have said is that if we see the opportunity to undertake intervention, then we will undertake it. In terms of what we're doing, we basically don't comment on individual transactions. We wait until is it the table F9, Grant? F5 that comes out at the end of the month. So.
But if I could just confirm that your policy of intervention hasn't changed at all. You remain active in that regard.
Our policy is that if we see opportunity to try and, for example, take the tops off any exchange rate peak, for example, or if we see opportunities if the market's gapping or there are discontinuities in terms of the degree of liquidity in that market, then we may exercise intervention if we think it appropriate. But what we wouldn't do is if there are very strong flows, capital flows, we wouldn't try and become engaged in trying to offset those in a substantive way or at all.
Can you explain what you mean by speed limits?
Yeah, if for example, high LV lending, let's take 80% LV ratio. If that's currently around 30% of new mortgage lending, we could say, well, over the next 3 months, we want to see instead of 30%, we want this reduced to X%.
Hi, I understand that the intervention in April was actually higher than the 256 million. Can you confirm that you actually bought back some New Zealand dollars during April?
Did you want to mention that, Grant? No.
You got a microphone?
Oh, sorry, we can share.
Well, the amount shown on the table is a net figure. So there could well be a gross sales of New Zealand dollars that are greater than that figure, offset by some buybacks. No, we just published the net figure, but you should be aware that that is a net figure, not gross.
You have a box with 2 alternative scenarios, one in which house price inflation is stronger than you expect and also one in which the dollar is higher. But you allow the possibility that, and the policy response to both of those is different, it's opposite. What happens if you get both at the same time? Do you end up doing nothing and therefore have the wrong response to both of them? Or?
Let me offer that one to John.
Well, first let me highlight that, of course, the target is inflation. So the policy response will average out and be the right one in terms of controlling inflation. Of course, we will still continue to see continued pressure on both house prices and the exchange rate. And in a degree, it's not that it's something that would be new. It's what we're facing right now. We've got a view that house prices already are overvalued and that the exchange rate is also overvalued. And to an extent, monetary policy can't be aimed at everything simultaneously.
Mr. Wheeler, there was a continued discussion yesterday at the Finance and Expenditure Committee about capital gains taxes. Does the bank share the view of the OECD that that would be a useful tool if it was applied across the board in New Zealand?
The issue is how might it be applied if it were to be applied. I think in many countries that do apply capital gains taxes, they exempt residential first homes, etc. If an investor is buying and selling houses, turning them over quite rapidly, then in essence they'll be taxed on that in terms of the current IRD regime. If you were to say, let's put a capital gains tax on investment houses, investor properties, etc., the issue is, I think, how much revenue would you drag in from that? But another way of looking at it is to say, well, to what extent, if investors see that they've got a higher incidence of tax when they finally sell that house, to what extent will it affect their behaviour at the beginning of whether to make that investment or not? And that's the key issue. How much of a deterrent would it be? For people who basically are prepared to hold on to houses for a long time and undertake multiple investments, then it may not be a terribly significant deterrent.
Do you think that the measures been placed in the 2010 budget to sort of crack down on loopholes for depreciation on rental properties, which were aimed at trying to slow down some of that property investment, has that worked in your view?
I can't be specific on that, but I understand the Treasury believe that it's been quite important.
The Policy Targets Agreement says that you must monitor asset prices. Do you think the Policy Targets Agreement or the Reserve Bank should give you more power to target or burst asset bubbles?
Well, in essence, this whole question of asset prices and asset price increases has very much come into focus, I think, probably since 2006 onwards. I mean, leading up to the period 2007, when the global economy was growing at its fastest rate for 4 decades, you did see rapid house price inflation in many economies. And the debate then was central banks that are pursuing flexible inflation targeting, focusing on inflation outcomes, how should they manage a rapid increase in house prices? And the view that some central bankers had, and particularly Alan Greenspan, was essentially that central banks could do very little about rapid house price or rapid asset price inflation, and should be very active when those bubbles burst. Now, there was quite a lot of controversy around that point, but since 2007, when you've seen just the dramatic impact of falling house prices in terms of household balance sheets and corporate balance sheets and just human distress, there's been a considerable change in view, and that's why central banks around the world and the BIS and the IMF have worked so hard looking at other potential tools, with one of those tools, of course, being the set of macroprudential policies. So should they be also operating at a time when central banks are also applying flexible inflation targeting?
Macroprudential tools, there's been quite a bit of commentary in the last month looking at how other countries have done them, and sort of basically said, look, it's not at all clear these things are working. What do you rate your chances are of the tools you're looking at working on a score of, say, 1 to 10?
I try and avoid report cards, but there's, as I say, there's a number of countries that have looked at these tools, and particularly Canada, the Scandinavian countries, Norway, Sweden, Korea, and Israel, that I'm aware of. There may be others as well. The IMF did a survey just recently. They held a conference on macroprudential policy and inflation objectives probably about 2 months ago. And their conclusion was that when you have very rapid increases in asset prices, they really can be effective in reducing some of those pressures and reducing the risk of financial distress. They even went further than that and said, looking at periods growth after a financial crisis, can macroprudential tools make a difference so that post-crisis growth, if you like, would be higher than it would be in the absence of those tools. So they found some results that were positive in that regard. I'm not sure how much weight to put on those, but I would put weight on the fact that you can take some of the pressure off house prices and you can potentially reduce some of the risk of financial crisis. But these tools, as I said in the speech 2 weeks ago, they're no panacea. I mean, if we introduce them, we'll be feeling our way through them to some degree, just like most central banks do.
Could the Reserve Bank use the official cash rate and increase to try to burst this asset bubble in Auckland housing?
I mean, if you look at, say, the period 2003 to 2007, when we had the most rapid house price inflation in the OECD, it was driven by some different factors. I mean, immigration was very strong, particularly in 2003, 2004. The numbers were very high. They're not so high at the moment. I mean, we saw something like a 1,600 increase in migration, I think, in April, but it's nothing like what it was in 2003. But if you look at the tightening that was required during that cycle, it was 325 basis points. I mean, it's very substantial. Once house price inflation starts to get away on you in a generalised sense and spilling over into more generalised inflation, it becomes very difficult to address it without significant rises in interest rates.
Has house price inflation gotten away on you, given it's forecast to be 10% plus, and even in one of your scenarios, 14%?
Well, for the country as a whole, house price inflation is running at 4%. It's running particularly high in Auckland and Christchurch.
Just to clarify, so for first home buyers in Auckland in particular, what is the message to them about these LVRs? That is it fair to say they could or will find it more difficult to get loans unless they have that 20%?
What I think we'd be saying is that if we introduce speed limits around LV lending, we'd basically be saying to the banks, these are the limits that we want in terms of high LV lending, and it's up to the banks to make judgments on how they allocate that across their customer base.
I've got a sort of two-tier question, as it were. I guess we sort of seem to be talking about two things here. One is the house price inflation itself, and the other one is the spillover from that into other inflation. I suppose the first question is how you determine when you're getting spillover and what you see as the triggers or the indicators for any spillover.
Let me make a few comments and then ask John to add a few thoughts. I mean, what you saw in 2005 to 2007 was house price increases spilling over into private consumption, and that was fairly evident in terms of the sort of consumer items that were being purchased and that sort of thing. We're not seeing anything like the degree of spillover that we were seeing in 2005 to 2007, which is not to say that it isn't there, because consumption has been stronger than what we had forecast just a while back. But Let me ask John.
It's an interesting question. I mean, traditionally in New Zealand cycles, the New Zealand economy booms together with house prices, either because people are feeling good about spending generally, or because they have more collateral, or because they feel wealthier. What we're seeing this time is perhaps in the wake of the global financial crisis, just a little bit more caution from the household sector. And so we've moderated the degree to which we think the spillover will occur. Now, of course, that takes careful monitoring, because to date that seems to be right. It's how it's playing out, but there's no guarantee that would continue if we've got a real acceleration in house prices.
Governor, I was just curious. Sorry. With the breakout box between the tensions of currency and the housing market inflation, which is seen as the more likely risk from your point of view? I mean, and which would be a greater risk?
John, did you want to?
Actually, we view them as about equal. And in a sense, both are taking place right now. We've got a picture where we already think house prices are stretched, and we already think the New Zealand dollar is overvalued. And so the illustration was we were separating them for analytical purposes, but you also have to put them together in your mind to get a sense about how it would play out in terms of the economic developments and the policy response.
Just, I guess, following up from your comment, from your earlier answer to my question about household caution, etc. There's been a few signals lately that perhaps that might be being relaxed, with savings rates now coming back to zero, which is an improvement, I know, on what they have been historically, but that still, I guess, seems to indicate some relaxation there. How close are you monitoring that, and to what extent do you just see that as a risk for your outlook?
No, that's a good point. And if you go back 2 or 3 monetary policy statements, what you'll see is we had an assumption that savings rates would turn positive. So we were thinking there would be quite a lot of caution. If you look at the current monetary policy statement, we've got household savings rates now back to about 0. So we're seeing a slight relaxation of that assumption.
And the risks around that?
And so we're watching a range of indicators. You can think about how confident do households feel about current conditions, how confident are they about spending on durable goods, houses, and so on. Again, you asked about monitoring. It's what we do, and we'll continue to do it. And for the moment, we think the central scenario is one where we've got a savings rate that's about 0 for the household sector, relative to minus 9% in the last boom. Now, that's a big difference.
Yeah.
On the issue of macro-prudential tools, Governor, last year you said even if you had them, you wouldn't use them. Now that you have them, will you use them?
I think I said, and I'm pretty sure on this, I think I said at that time. So that was the correct quote. I've been misquoted on that on occasion. Will we use them? We're giving serious consideration to it, given the house price pressures up in Auckland and elsewhere.
What sort of time frame do you think there is for a decision on that?
Well, we've asked banks to consult and get back to us, and any other parties that are interested in providing comment by early July. We'll be looking closely at that feedback over July, and I would expect us within the institution to be making judgments after we've looked closely at that feedback.
Just to follow that up, so the earliest the speed limits on LVRs could be, August?
Well, we haven't, as I say, Jim, we haven't made any decisions on this. We'll look closely at the feedback, and then we'll make judgments about what we think is appropriate in the circumstances. But we'll be having those discussions inside the bank during July.
Is there a risk that the people seeing this coming down the track will accelerate mortgage lending and people will rush to get in before this shock and awe policy descends on them over the next couple of months and give you therefore a false signal about the underlying demand?
I hope it's not a shock and awe policy. We've tried hard to communicate hopefully quite transparently in terms of the way we think in the institution. And as you know, Brian, we do a lot more public speaking these days. But forgive me.
Is there a risk that you get a surge in
demand? Sorry, Brian. Yes, I think that is a risk. It's a risk if an institution is considering any type of regulatory intervention of any sort, and you get the same basically if there are possibilities of increases in tax rates or any other regulatory intervention. Yeah, Grant.
I'd probably add that I don't think there's any particular evidence that's actually happening. I don't think there's any particular evidence that's happening right now.
And we would hope that it wouldn't happen. But, there will always be a risk.
Just to clarify, the speed limit, you talked about it being brought down from 30 to X percent. Can you tell us what X percent is?
Not at this point. We're still discussing inside in the bank, and we want to take a close look at the feedback we receive from the financial intermediaries and others.
Could I put it another way? Was 23% a sort of more acceptable level?
I think, given the sort of house price inflation we've been seeing, one would want to see house price inflation or high LV lending. Let me put it that way. You'd want to see high LV lending slowing down.
As far as the risk of preemptive buying in by home buyers, I was wondering more about a bit of preemptive stock or capital building up by banks, as it were, in advance. And there's no evidence of it yet from what I've seen of deposit rates. But is that a possibility? A, B, would it worry you if they did?
Mm-hmm. Do you want to offer some thoughts on that, Grant?
Sorry, could you clarify preemptive behaviour of what sort?
Well, I suppose. Probably less to do with the LVR, but probably more to do with any capital buffer build-up. Banks effectively making sure they got a bit more in the kitty for before any rules change.
Yeah, I think the banks are very well capitalised. They've got good liquidity and capital buffers, so they're not particularly constrained at present. And that may be one of the issues in terms of the acceleration of credit growth that we're seeing. But my previous comment was that in terms of the proportion of their lending that's high LVR, that at present is reasonably stable, around 30%. It's increased to 30%, but it's at present, in recent months, it hasn't been going beyond that.
In box B in the monetary policy statement, there's two scenarios. One is a higher house price inflation than your central forecast, and the other is a higher New Zealand dollar than your central forecast. But do you think there's the third potential scenario for both a higher New Zealand dollar and a higher house price inflation, given that there seems to have been a correlation between the two in the past? And what would you think of a scenario like that?
There's always a risk. Could you see a situation higher house price inflation and a higher exchange rate, that's what in fact we have been seeing. We've got an overvalued exchange rate. We have an overvalued housing market. That's what we have been seeing. At the moment, and thankfully, the exchange rate is starting to weaken, and hopefully it will continue to do so.
And the report also notes the increase in the fixed portion of mortgage lending to almost 50%. At what point do you become concerned about how that affects the potency of your monetary policy?
Well, the fixed floating mix at present, you're right, is around 50%. But most of the fixing has occurred over maturities of 1 to 2 years, or over that sort of period.
Which means you're not so concerned about it?
Well, I think it means that it means that if we do get into a situation where we are increasing the OCR, then I don't believe the potency of increasing interest rates will be dramatically affected by the fact that fixing has occurred for a period of 1 to 2 years.
Governor, are there any other areas of credit expansion that are causing you risk, or is it mostly in residential?
Well, did you want to offer thoughts, Grant, maybe?
I mean, in the recent last financial stability review, we're mainly talking about housing risk, but we did also mention agriculture, and we've mentioned agriculture on previous occasions where debt levels remain high relative to incomes, and so there are still risks around that sector. That's the main other sector that we've highlighted.
Yeah. Getting distressed as a result of the drought? Have you seen any incidents of that?
Not really, no. And dairy prices, of course, have increased partly as a result of the drought, and that's actually improved income outlook. So in terms of debt service, they're looking reasonably comfortable. The risk is if there was a significant downturn in export prices, dairy prices. But the drought, as it turns out, has not been a major factor for debt serviceability in the dairy sector.
If you look at other categories like SME lending, for example, then that's not increasing very rapidly at all. If you look at lending to the dairy sector, as Grant talked about, I mean, essentially loans outstanding to the dairy sector increased from just, I think, from memory, around 10 billion about a decade ago to roughly 30 billion now. The problem is in that area is the distribution is highly skewed to a small proportion of dairy farmers, and that's the potential risk there.
Does the Reserve Bank have a view on whether the government should get more involved in increasing housing supply in Auckland, given that the private sector has not increased it much lately?
I don't have a view on what the government should be doing in terms of its housing portfolio, no. Well, thank you very much indeed.